Alright guys, welcome to this lesson on bearish RME. A little bit disclaimer first before I move on. So basically what is bearish RME? The pattern looks something like this. So it's the opposite of bullish RME. So you have a big large bull candle followed by a small red candle. So basically initially the buyers are in control during the first candle. During the first candle, buyers are in control. Then the sellers start to come in and then prevent buyers from taking over, and hence it prevents the price from going up. So hence sellers are starting to come in. Okay, so when you see a big bullish candle followed by a small bearish candle, then this is a bearish RME. So what does this indicate? This indicates the end of the bullish trend. So normally when you see this pattern, it tells you that the price is going to go down. Okay, it's going to go down. And bearish RME would cause a temporary market correction, or it might cause a reversal of the whole entire trend. Okay, it might either cause the end of the trend, end of the bullish trend, or it might cause the markets to correct downwards a little bit before it continues its direction upwards. And again, when it comes to bearish RME, the wicks are not that significant. The body size is more significant. Okay, and of course you want the candle colors to be big green candle followed by small red candle. That's the ideal situation. So if I'm to ask you which signal is stronger, is the first one stronger or the second one? So if you have watched the previous lesson, you might have known already. The bigger the difference between the two candlestick body sizes, then the stronger it is. So in this case, the first pattern will be stronger than the second pattern. Now the second pattern will be more neutral because the candle body for the second candle, it goes all the way until the midpoint. In fact, it exceeds the midpoint of this first green candle. So it is more neutral than a bearish signal. Okay, so let me give you one example. And I drew this resistance zone over here. So the bearish RME was sitting at the resistance zone. So you can see that this is also a double top pattern. Okay, if you know chart patterns, this is also a double top pattern. But I'll reserve chart patterns for another course because I don't want to confuse you too much. But for now, just focus on the candlesticks. Okay, so how you can approach this trade is that you want to wait for the price to close below the low of this bearish RME pattern. Okay, and then you can enter on that candle. So what you can do is that you can put your stop loss slightly above the bearish RME pattern. Okay, you can put it right here. So which candlestick close below the low of the bearish RME? This red candle over here. So the candle close over here, so you can make a sell over here. Alright, now why is it that I can make a sell over here despite the fact that there's a trend line over here? Because if you zoom out from this chart, and also if you look at H4, it is actually still in a downtrend. In the bigger picture, it's still in a downtrend. Second thing is that this trend line is not very strong. Why is it not strong? You will know the answer when you go through the trend line lessons. Okay, but for now, if you're aggressive, you can sell here. If you're a little bit more conservative, you might want to wait for it to break the trend line and then you can sell here. Alright, so then how do you set your TP target? Now to make things simple for you, what you can do is that you can set your TP target at the swing low. Okay, at the swing low, and you only enter when there's a good risk to reward ratio. So you can put your TP target slightly above this low over here. Okay, because you don't want to put it right at the bottom. When it comes to TP target, you want to be more conservative and set it slightly above the swing low. Alright, but if you're sold at this level, okay, if you're sold at this level, you can potentially want to TP here as well. Alright, but if you sold at this level, what you can do is that you can TP at this level so that you get a good risk to reward ratio. So your risk appetite will determine when should you sell. Okay, when should you sell and when should you TP. But if you know chart patterns, your TP target will be more certain, because if you learn chart patterns properly, you would know that when it comes to double top, there's a neckline which you can draw. Alright, where the price came down and test this level before it bounced up. So you take this level from here to here, and then you project the same distance downwards to get your TP target. okay, the same length. So there are many ways that you can approach this trade, okay, but of course don't just rely on candlestick patterns alone for you to go in, because you need more confirmation indicators. So I want to share with you how bearish army would work out in an uptrend. You realize that when it comes to bearish army in an uptrend, when it does appear, especially at the start of the trend, it's going to cause the markets to retrace, okay? And as you can see that the price came down and then test this 100 SMA. Another one appeared again over here, bearish army. This was not that strong, it's more neutral. Price retraced a little bit before it went back up. Another one over here, okay? Ideally, you don't want any shadows on the red candlesticks. So you can see price retraced a little bit before it went back up again. And this bearish army over here, why did it fail? Because first thing first, the second candle exceeds the half of the first candle. Do you see that? Alright. And the other thing is that when it comes to bearish army pattern, okay, you have a big green candle, you want a small red candle, you need a third confirmation, okay? You need a third confirmation, which means that you want the third candle to be a red candlestick. So can you spot any more bearish army patterns? There's one more over here. Alright, this one is more ideal. You can see that second candle is small relative to the first candle, and also the third candle is a red candle, which means that is a confirmation that price would potentially retrace. And in fact, this whole entire trend ended and it went all the way down. So it's very important for you to learn how to spot false signals when it comes to trading any candlestick, okay, any candlestick. So again, you can see that why did this bearish army pattern fail? When it appeared, it is supposed to go down, right? The price is supposed to go down, but instead of going down, it ranges a little bit before it went up. Why is that? By now you should know already. First reason, because the third candle, can you see that? This is more like a doji or spinning top, okay? Basically, the third candle is not a bearish candle, okay? There's no third candle confirmation. You want the third candle to be a bearish candle, alright? Second reason why did it fail? Because this is a bullish trend. You know that in a bullish trend, price has the tendency to go up or down. Price has the tendency to go up. And even if a bearish army appears like just now, it would retrace a little bit before it continues to go up. Understand what I'm saying? So when it comes to bearish army in a bullish trend, you don't really use it to enter on a sell because you don't want to trade against the trend. So when can you sell? You sell only when you see bearish army in a bearish trend. And not only at just any bearish trend, the bearish army has to appear, remember, at a critical level. So for example, can you see there's a bearish army over here? Right? This one is good. You can see the green candle followed by small body red candle, then the third candle that appears, okay? Third candle that appears, you can see that there's a big red candle and that closed below the low of this bearish army. Do you see that? So this is a confirmation that price is going to continue to go down. And the thing is, it also tests this trend line, okay, trend line. And can you spot another bearish army over here? I would say this is more ideal as compared to the previous one because it not only tests the trend line, but it also tests our 50 SMA. Okay? As you can see also, the third candle that appears, it's also a red candle. Okay? And also at the same time, you see RSI. Remember, when you're in a bearish trend, you want to sell when the market goes to overbought, okay? So at the same time, you can see RSI went from overbought and then it goes back down to neutral level. So you have many confirmations that the trend is going to continue to go down, so you can enter from here. Okay, so I give you another example. This currency is pound yen, okay? So if you can spot where the bearish army is, so here it is, okay, here it is. And as you can see again, it is formed at a critical level. It is formed at our 200 SMA. Okay? And you can see a support zone over here, which I drew based on this level, this low, and also this low. Okay, so you can see that first thing first, price tested 200 SMA. At the same time, your CCI, okay, went to overbought and then it came back down to neutral level. What you can do is that you wait for the price to go below the low of the bearish army, which is somewhere here, and then you can enter a sell trade somewhere here. Put your stop loss slightly above your bearish army, because no pattern would work out 100%. And then what you can do is that you can take profit at your support zone, right over here. So you have a good risk to reward ratio. You're not trading against the trend, you're trading along with the trend, so this would be considered a good trade to get into. Alright, so I'll give you one more example. So you can see bearish army is over here. Okay, of course this is not super ideal, but it forms at our 200 SMA. CCI went to overbought and then went back down to neutral level. So if you are more aggressive, you can enter earlier. You can enter here. Why is that? Why do you not want to wait for price to go below the bearish army? Because right now in this context, it tested our 200 SMA resistance. But if you're more conservative, yes, you can wait for price to break below bearish army, because at the end of the day, how you enter depends on your risk appetite. Okay, so you can enter here if you're more conservative when the price broke below bearish army, and then you can put your TP target right at the support zone over here. Okay, now the thing is, if you entered earlier, you would have a good risk to reward ratio, but if you entered later, you're a conservative trader, then your risk to reward ratio would be not so ideal. So you need to think to yourself, is this even worth the trade if you enter from here? Okay, so the downside about conservative traders is that you will enter later than aggressive traders. But the downside with being an aggressive trader is that you are going to experience more losses. But the good side about being an aggressive trader is that your risk to reward ratio would be better than a conservative trader most of the time. This applies to other trading systems, not only candlestick trading. Now if you look carefully at this chart, why did this bearish army not work out? Can you see? This bearish army did not work out. Why is that? Can you spot the false signal right now? First thing first, the third candle, there's no confirmation on the third candle. The third candle is a big bullish candle, so you wouldn't have entered into that, right? It might be testing this resistance over here. Okay, that might give you a clue, but then again, the third candle is a big bullish candle. So if you're not patient enough and you entered right away when a bearish army is formed without waiting for confirmation, you're going to get stopped out a lot. So when it comes to candlestick trading, you also need to take care of your trading psychology, because no matter what strategy I teach you, if your trading psychology is not on point, then nothing is going to change. Okay, here's another example. Can you spot where the bearish army is? By now you should know where is it. Okay, over here. Okay, again, look at our criteria. First thing first, are we trading the bearish trend? Yes, of course. Our 50 is below 100 SMA, 100 SMA is below 200 SMA. So next thing you will look for is our bearish army pattern. And next question you need to ask yourself is it formed at critical levels? Okay, is it testing any resistance level? Yes, it is. It is testing our 100 SMA. I don't know if you can see this a white line. It went all the way down here. Okay, and it is also testing our trend line. Okay, this green line over here, this trend line. Oops, let me just rub this. It is also testing a trend line. Okay, and then look down to your confirmation indicator. Is there an overbought? Yes, there is. Okay, so CCI went from overbought back down to neutral level. So if you're an aggressive trader, you can enter right after the third confirmation is formed. Okay, which is this candle over here. You can enter right here. Alright, but if you're more conservative, you can enter over here, which is still okay. It closed below the low of this bearish army, and then you can put your stop slightly above the bearish army, which is this line over here. okay? And then you can put your TP at the recent swing low, which is right here. And you don't want to set your TP, like I said, right at the point over here. You want to set it slightly above the swing low. Understand what I'm saying? So for this trade, regardless of where you enter, whether you're a risk taker or conservative trader, you still get a good risk to reward ratio. So this would be a good trade to go into as compared to the one just now, where if you're a conservative trader, your stop loss is wider than your TP target, which is not so good. Okay. Another criteria for you to enter is to make sure that risk to reward ratio is at least 1:1. Okay, so there's another derivative of the bearish army, and that is bearish army cross. Basically, it looks something like this. The only difference is that the second candle, instead of being a small red candle, it is now a doji. There's a large bullish candle followed by a doji pattern, and there'll be a potential reversal from bullish to bearish if you see it in an uptrend. But yet again, it can also cause a temporary market correction, just like the normal bearish army. So basically, it still signifies the same thing. The market is going to go down, potentially going to go down, not guaranteed, okay? So if you want to ask, is bearish army cross stronger or is the normal bearish army stronger? Definitely bearish army cross, because the doji, it increases the uncertainty. So hence, if the third candle is a bearish candle, then this increases the chance that the price is going to go down from there. Let me give you one example. Can you spot where's the bearish army cross? So first thing first, you see that this is a bullish trend, okay? So in the presence of a bearish army cross, you'll know that the probability of the price reversing to a downtrend is not that high because this is an uptrend. So can you see where is it? If I'm to draw it right here. Okay? So why did this bearish army cross not work out? This pattern formed, but instead of the price going down, it went up. Why is that? First thing first, because this is an uptrend that you're trading at. Second thing is that the following candles, it cuts above the high of this bearish army cross pattern. Okay, so subsequent candles actually close above the bearish army cross pattern, and hence you know that this signal failed. Now, when the bearish army cross fails, this actually signifies one thing. It tells you that the bullish trend is strong. Okay, so the failure of a pattern or signal can actually signify to you that the trend, the bullish trend, is very strong. Okay, so it's not completely useless when there's a false signal. So of course, along the way, at the start of this trend, you see a bearish army, a normal bearish army, and you can see that the third pattern is a spinning top, then followed by subsequent candles forming lower than the bearish army pattern, and hence it came down here, tested the trend line and your 50 SMA, and then it bounced off. So this is a market correction instead of a reversal. Okay, and again you see another one here which tested the 50 SMA, went down all the way to the swing low before it bounced back up. Now I realize that by now bearish army pattern is more common than bearish army cross. You don't often see bearish army cross that often, but if you do see it, make sure that you take note of it, okay? So the thing about reversal patterns like bearish army cross or bearish army, it can be used to also spot a false breakout. Okay, a false breakout. So you can see that I drew this resistance zone, and in this case I drew a line. Okay, I drew this resistance right here, and along the way there's a breakout over here. Can you see that? Okay, a breakout, and immediately there's a signal over here, a bearish army cross signal that tell you that okay, this might not be a good breakout to go into. This is a false breakout. Understand what I'm saying? But you know, if you learn to draw resistance zone, you know that this is a false breakout. But just by candlestick alone, you can tell that this is a false breakout. And eventually this candlestick, this red candlestick, closed below the bullish army cross pattern. So you wouldn't want to buy into here, okay? You wouldn't want to buy into here. And especially when RSI is overbought. Okay, and as I already taught you previously, this is the bullish trend. At the end of the trend, when you see a big green candle where buyers push the price up, high chance that buyers will start to take profit. Okay, and yes, they did. Then eventually the bullish trend ended and went on a downtrend. So in a way, you can also use all these reversal patterns to spot false breakouts. So when it comes to trading bullish army cross pattern, you can treat it the same way, just like bearish army pattern. Okay, so right here I have a signal over here. This is not a super ideal bearish army cross because you see a little bit of a spinning top pattern on the second candle. Okay, it's not entirely a cross, a doji, but it's still a signal worth taking note of because you see a big difference between the sizes of these two candlesticks. I drew this resistance zone over here. Okay, based on this point and also this point. So you can see on the third touch, the bearish army cross is formed. And as you can see, this is a sell market, so you're looking for a sell trade. So you need to ask yourself, is this pattern formed at critical levels? First thing first, it tested your resistance zone. Second thing, it tests your, what line is this? Your 100 SMA. Okay, and when it tests your 100 SMA, your CCI gave you an overbought signal. Alright, gave you an overbought signal and then it went back down later on. So what you can do again is that you can set your stop loss slightly above the resistance zone. You can wait for price to close below the bearish army cross pattern, which is somewhere over here. Okay, so you can open a sell trade here and then you can TP based on previous swing low. So you get a risk to reward of about 1:1. But if you're a little bit more aggressive, you can enter somewhere here. Okay, you can enter somewhere here. But with that said, your entry will be very near to your stop loss, but you get a good risk to reward ratio. So again, like I said just now, aggressive, conservative trader, you decide because you gotta trade based on your risk appetite. Just make sure that you enter into a trade when the risk to reward ratio is good. So with that, I hope that this lesson gives you a clear idea on how to use bearish army, and I'll talk to you in the next lesson. Bye.